Mutual funds. Let's start with the classic, mutual funds. These have been around for nearly a century and are one of the most common investment options offered by banks and retirement accounts. Here's how they work. A mutual fund takes money from thousands of investors and pools it together. That big pool of money is then managed by a professional fund manager, whose job is to pick and choose stocks, bonds, or other assets in an attempt to make a profit for everyone in the fund. Sounds good, right? Someone else does the work while you sit back and hopefully grow your wealth. But here's the catch. All that professional management comes at a cost. Mutual funds usually charge higher fees, often around 0.5% to 1% per year, sometimes more. It might not sound like a lot, but over decades, those fees add up and can eat away at your returns. Another downside is liquidity. Mutual funds only trade once per day after the market closes. That means you can't buy or sell them instantly like stocks or ETFs. So who are they for? Mutual funds are great for investors who want a hands-off approach and are okay with paying for professional management. They're especially common in 401ks and retirement accounts. But if you're looking for efficiency and lower costs, there are better options. Index funds. Now, let's talk about index funds. These are technically a type of mutual fund, but they flip the game completely. Instead of having a fund manager try to beat the market, an index fund does something much simpler. It just tracks a market index, like the S&P 500 or the NASDAQ. Think of it this way. Rather than betting on individual players, an index fund bets on the entire team. If the US stock market rises over the long term, your fund rises with it. No guessing, no gambling, just steady growth that mirrors the market. The beauty of index funds is their low cost. Because there's no active manager making decisions, fees are usually tiny, sometimes as low as 0.03% per year. Over decades, that difference in fees can literally mean the difference between retiring comfortably or not. Warren Buffett himself has said that for most people, the smartest investment is a low-cost S&P 500 index fund. That's because over time, the stock market tends to rise, and trying to beat it is incredibly difficult, even for professionals. The downside? Index funds won't beat the market. They'll give you average returns, but in investing, average is often better than paying more for someone who tries and fails to do better. ETFs, exchange-traded funds. Next up, we have ETFs, or exchange-traded funds. Think of ETFs as the modern cousin of index funds. They can track an index, a sector, a group of companies, or even commodities like gold or oil. But here's the difference. ETFs trade just like a stock. You can buy or sell them at any time during the trading day, not just once at the close like a mutual fund. That flexibility makes them very popular with younger investors and people who like to be more hands-on. ETFs also tend to have very low fees, similar to index funds, and in some cases, they're even more tax efficient. That's because ETFs use a unique structure that minimizes capital gains taxes compared to traditional mutual funds. For example, if you believe in renewable energy, you can buy an ETF that tracks clean energy companies. If you want exposure to tech, there's an ETF for that. If you want to diversify into international stocks, there's an ETF for that too. Basically, if you can think of it, there's probably an ETF out there. That's why ETFs have exploded in popularity in the past decade, with trillions of dollars invested worldwide. The only caution? Because ETFs are so easy to trade, some investors treat them like short-term stocks and end up overtrading, which can hurt long-term returns. But if used properly, ETFs combine the best of both worlds, diversification and flexibility. Hedge funds. Now let's talk about the wild side of investing, hedge funds. Unlike the other three, hedge funds are not for everyday investors. In fact, they're usually restricted to the wealthy, so-called accredited investors, who can put in hundreds of thousands or even millions of dollars. Hedge funds are managed by highly paid professionals who use aggressive strategies to chase big profits. These strategies can include short selling, derivatives, leverage, and betting against the market. The goal isn't just to match the market like an index fund, it's to beat it, sometimes in dramatic ways. Some of the richest people in finance, like George Soros and Ray Dalio, made their fortunes running hedge funds. But here's the reality. For every hedge fund that succeeds, many fail spectacularly. Hedge funds are also notorious for their 2 and 20 fee model, charging 2% of assets under management, plus 20% of profits. That's insanely expensive compared to index funds or ETFs.
And because they're lightly regulated compared to mutual funds, they can take risks that sometimes blow up. Remember the 2008 financial crisis? Hedge funds were right in the middle of it. So while hedge funds might sound glamorous, for most people, they're more of a curiosity than a practical option. Unless you're ultra wealthy, they're not even accessible. Side-by-side comparison. Mutual funds. These are investment pools managed by professional fund managers who make the decisions on what stocks, bonds, or other assets to buy and sell. They're designed to be beginner-friendly since you don't have to do the research yourself. The trade-off is that they usually come with higher fees and management costs. Another thing to note is that mutual funds don't trade in real time like stocks do. You can only buy or sell them at the end of the trading day when the fund calculates its net asset value, NAV. Index funds. Index funds are a type of mutual fund, but instead of active management, they passively track a market index, like the S&P 500. Because they don't require constant buying and selling by a manager, they usually come with very low fees. They're built for long-term investors who want steady market growth without paying too much in costs. You won't beat the market with an index fund, but you also won't fall far behind. It's a simple, low-maintenance strategy. ETFs, exchange-traded funds. ETFs are like a mix between mutual funds and stocks. They give you broad diversification, but unlike mutual funds, you can buy and sell them throughout the day, just like a regular stock. This makes them flexible for short-term traders and long-term investors alike. They also tend to be tax-efficient and have low fees, which makes them popular. Plus, there's an ETF for almost every sector, region, or investment strategy you can think of. Tech, healthcare, clean energy, bonds, even commodities like gold. Hedge funds. Hedge funds are in a league of their own. They're usually only open to wealthy investors because of their high minimum investment requirements. Managers use aggressive strategies, like short selling, derivatives, and leverage, to try to generate massive returns. The upside is potentially huge profits, but the downside is very high risk and very high fees, often 2 and 20, meaning 2% management plus 20% of profits. Despite the hype, many hedge funds actually underperform the market, which makes them controversial.